Thanks so much for joining February Hangar Talk. Let's kick things off. We have a lot to talk about because, boy, if you read our past newsletter, we have been busy. It's been an incredible start to the year. As we mentioned in the newsletter, we've been a little bit quiet externally, but there's been a ton of stuff going on internally. Why don't we start with the HubSpot transition, and we can talk about some of the new team members because the HubSpot transition isn't quite as critical. So, Brittany, do you want to talk about what that is? Basically, we've been doing a heart transplant while we're walking. So all the emails that you get from us and our central email system that we use to send out communications to investors, we've been moving over to a much more capable platform. And Brittany, you've been spearheading that. So I don't know if you want to talk a little bit about what this means for investors.
Yes. So as Tait mentioned, HubSpot is a platform that we will be utilizing to send out all our communications. So just know that it's allowing us to make sure that you're taken care of throughout your entire investment journey with us. Additionally, this means that coming soon, there'll be new updates to how you can communicate with us. If you're new to Turbine Capital, you may have gotten a text message from us recently. So that's our one-to-one communication. It's a direct text line. We will be updating our phone number for that. So stay tuned as we are transitioning to a new phone number. In addition to that, we will be standing up one central line to contact anyone within our team. That way you have the Turbine Capital team at your disposal. Like Tait said, you might not see it. It's in the background, but it's definitely going to enhance your experience with us.
Excellent. Thanks, Brittany. So just to double tap on that, new two-way text communication line, and we'll also be introducing an office line where there's going to be a phone tree where you can reach anybody you'd like, but you also have our direct lines as well. So with that, I'd like to turn it over to some new team members that we've brought on. So starting with Noell. Noell, welcome to the team. Noell Vinzon is based in Los Angeles, and she is our new investor relations coordinator. Noell is going to be handling all of your paperwork, your accounts. Obviously, Noell is much more capable than just a paperwork pusher. Noell, do you want to talk about your background a little bit? Welcome to the team.
So thank you, and I'm excited to be here with everyone here. Yeah, so like Tait mentioned, prior to coming to Turbine, I actually worked at a sponsor operator firm. We purchased and acquired multifamily real estate and provided value add, and then dispose of the assets and just kind of rinse and repeat. Yeah, been doing that for about 5 years and kind of in the private equity space before that, and actually started my real estate journey in the crowdfunding space. But yeah, excited to be here and excited to support the team and support the investors at Turbine.
Thanks, Noell. So everyone will have obviously some direct communication with Noell as your transaction is progressing. Once you're working on coming into one of our deals, especially if you're using a self-directed IRA custodian, Noell is going to be a really great resource for everyone to make sure that they're getting prompt communication. Additionally, if people need wiring instructions, things like that, Noell is going to be basically the centralized office from Monday through Friday, 9 to 5, so that you can always get a hold of someone. With that, pivoting over to Mark Fleming. For those of you who have been around for the last 6 or 7 months, you have heard about Mark because he came on originally as our oil and gas consultant last year and was helping us do extensive due diligence in the energy space as we spooled up our Iron Horse Energy Fund last year. We have moved decisively to add oil and gas as a permanent vertical within Turbine, and we, as such, have decided to bring some of these capabilities in-house. So after a month or two of discussions, Mark, we entered into an agreement early this year to bring you fully in-house. So as of today, we're officially announcing Mark Fleming as our managing partner of oil and gas. So with that, Mark, you turn it over to you to kind of talk about your background and the new role.
Hello, everyone. Excited to be here and glad to be on the team. Like Tait said, we are starting our own oil and gas fund this year, and got already had quite a few meetings, and we have a big conference next week, and we're looking to launch the fund in early April. It'll be similar from an oil and gas perspective to the fund we were previously in. It'll just be managed by us, but same concept, same assets, and same diversification.
Excellent.
Glad to be here.
And Brian, that's spot on. Oil and gas is here to stay. We love the asset class. We love the tax benefits, the cash flow. We think it's a perfect balance to real estate. Before we move on, Mark, do you want to just, for anybody that isn't familiar with your background, maybe talk about your long track record of expertise in the space?
Sure. So I started out my career at Chevron. I've helped two companies go public, and then my latest career move was at Hess before being a consultant for quite some time. And then as I was consulting for Turbine, it looked like a good fit, and we decided to work together permanently. So glad to be here.
Thanks, Mark. And I do want people to know that Mark was also consulting, not just for small PE firms, but for some very large banks. So absolutely incredible experience. Looking forward to seeing you in Houston on Monday evening for the Nate conference. With that, transitioning into the happy hours, because we have two conferences. The team is going to divide and conquer, and we have TJ, Brittany, and Noel headed to Salt Lake City for Best Ever Conference, which is the real estate conference. We're going to be having a happy hour there on, is it Wednesday? Okay. Brittany's nodding. Yes. All right. Happy hour is going to be at the White Horse Tavern in Salt Lake City on Wednesday. So if you're in town or if you're based in Salt Lake or anywhere nearby, we'd love to see you. We'll have three of these team members there. Mark and I will be hosting a happy hour in Houston at Stella's Wine Bar on Tuesday evening from 5 until 6:30. So hope to see some of you there. Last time we did a happy hour for the Passive Income Pilots podcast, we had people fly in for it. We'd love to see if you can make it. In any case, Brittany's dropping the links to register in the chat. Moving on to K1s. So we understand that K1s can be one of the most frustrating things about alternative investments. It's kind of the nature of the beast. So Ryan and I have talked about this on the Passive Income Pilots podcast. If you invest in enough private market deals, eventually you're going to need to start filing extensions. It's just it's the way it is. Now, if you do have a large tax refund that you're expecting and you don't want to wait until the summer to file, keep in mind that you can always amend. You're usually, at least in the first couple of years, you're going to see a negative K1. So you're going to see a tax loss. So it is going to improve your tax situation, not hurt it. So if you extend, then you're just waiting to file. You're waiting to get that refund. If you just go ahead and file by the deadline and then you amend later, you actually may get additional cash back. A lot of people worry that by amending later, they're going to get penalized because they didn't make an estimated tax payment. If you have an estimated tax payment that you need to make on a delayed K1, we will always let you know. We'll say, hey, you are expecting X amount. We'll always be conservative with that number so that you can make that estimated tax payment. We have actually only seen that once in one calendar year with one deal across the 35 that we manage. So it's a very, very rare instance that you would have to make an estimated tax payment. It is an additional expense potentially with your CPA to go ahead and file and then amend later. But the good news is that most of our K1s are scheduled to be on time this year. If you haven't seen this already, it's not the most high-tech solution, but it's a Google Sheet that shows every single one of our projects in alphabetical order with the estimated K1 delivery date, and we are live updating this as we move forward towards the filing deadlines. So you can see right here, if you're in REEF, unfortunately, that K1 is going to be late. But again, it's not going to penalize you if you just go ahead and file and amend later. Obviously, this is not tax advice. Consult with your CPA for the best course of action, but you can tell your CPA that it's either going to be a net neutral or a capital loss, a phantom loss. That's it for K1s. We'll turn it over to Q&A as well after this. So please feel free to type your questions in the chat. We'll address them or come off mute at some point. But we also wanted to touch base on fair market value reports for custodians. Those of you who are investing via self-directed retirement accounts, your SDIRA custodian is required by law to get from us a fair market value report that says, how much is this worth? And this is because it's a private market alternative investment. They have no idea how much it's worth. If you have an IRA with Schwab and you own NVIDIA stock, they know exactly what that is because it floats up and down with the market every day. They are required to track how much that is. By default, we will always just use your capital balance. So if you put $50,000 in the deal, we're gonna give you a fair market value report that just says it's worth 50,000. We go a step further than most firms, where we work directly with your IRA custodian to provide this. However, if for some reason they still ask you for it, it has been uploaded to your portal. So you can go in there and download this and pass it on if you're being asked for it. But please do know that we have already provided these directly to every one of the 15 plus custodians that we work with. Moving on, some exciting portfolio updates that we figured we'd share with the Hangar Talk crowd here. First, the 4 Mile Ranch project got its first distribution. We're very excited about that. It only amounted to about 6% of capital, but the cool thing about this was we sold the first 2 parcels on that land entitlement deal, and that only accounted for 9 acres. And if you extrapolate the $40,000 an acre across the entire 800 acres, it's a pretty strong showing of the amount of value that we're creating at that project. So congratulations to the 4 Mile Ranch investors on their first distribution. We have also entered into a finalized agreement with a third party to buy the golf course off of us. The biggest win about that transaction is Byron is buying the course. So he sold his office. He's doing a 1031 exchange and taking the course from us. And because that's an internal sale, it's a fair market value price that he's buying it for. But we are thrilled because he's going to inject a bunch of capital into the golf course, and he obviously has other ways to recognize that value back to him other than just the simple profitability of the course. He can run that course at a loss. And because he's a GP, one of the GPs of the 4 Mile Ranch project, we just see it as a wonderful alignment of interest. That will be another distribution that investors on the 4 Mile Ranch project will see here in the next few months as that goes through, and lots of project progress on that deal. Stealth Point. We have been very busy with our Stealth Point LPs over the last month. We had some exciting things occur within that portfolio. For anybody that is not familiar with the Stealth Point deal, this was a skunkworks offering. It is a portfolio of 8 venture capital companies, 8 startup companies. This was the VC fund, essentially. So we have 8 companies within the basket. 3 of them look like real winners, and one of them is really breaking out. And it is an imaging company that's able to do 3D imaging at the 1 nanometer level. And the company is called Ramona, and one of the largest VCs in biotech is leading a $25 million round, which is incredible. I mean, that's to be involved in a company at this stage where one of the largest venture capital firms in biotech is leading a round is just incredible. So we had contractual rights to participate in that round. We were able to go around to our LPs and say, hey, do you want to participate in this additional round? So super exciting there. The crux here is that cancer research looks like the most applicable application for the technology. This company, it looks in early research like they're going to be able to identify the roughly 1 in 100 white blood cells that are cancer fighting, find it, track it, and then they'll be able to actually grab that cell, clone it into a billion, and then re-inject them into the body and have some pretty successful cancer treatments with that. So yet to be seen, but very, very exciting progress on Ramona. So congratulations to the Stealth Point investors. We're really excited about that. We have some other, less maybe exciting news, but the private credit fund has just been a massive success. We had the strongest quarter to date with the private credit fund delivering north of 11% on average. And it looks like we've got another quarter of about $40 million in deployment within that fund. So really, really strong, just a fantastic vehicle. Reminder to those of you who are interested in just, plain, steady, low risk cash flow. That project is set up to either distribute on a quarterly basis or compound on a quarterly basis with basically no volatility. So over the long term, it's pretty amazing what you can do with an 11% return. So anyway, just wanted to share that update. The last order of business before we dive into Q&As are deals and trends. So upcoming deals and some trends that we're looking at and how we're looking at the general market here. The first is industrial. You've heard us talk about this. Nearshoring and reshoring are just massive tidal shift. This is going to be a decade plus long play where we're seeing manufacturing move home from places like China, India, Vietnam to the United States and Mexico, really. We've been tracking this for a number of years. This was already in play post-COVID. This was not just related to the tariffs. This was because of supply chain vulnerability being exposed during COVID. You remember that Ford at one point had tens of thousands of F-150 pickup trucks piling up at their facilities because they didn't have a microchip that needed to go into them, and they couldn't deliver it without the chip. And the cost of that was just, I mean, it way outweighs the savings of manufacturing something overseas when labor costs in these overseas markets has risen dramatically. Shipping costs are extremely volatile and have settled out markedly higher than they were pre-COVID. And then you layer on the tariffs, and it's even more compelling. I like the phrase, we can't time the waves, but we can time the tides. And this is a decade long or even multi-decade trend that we're riding. And so it's important in industrial to be in the right market and have the right size, because the big bomber facilities that are in San Bernardino and some of the larger markets have been overbuilt, and that's sometimes the headlines that you might see. But when you look at sub 250,000 square foot in strong industrial markets, vacancy rates are typically below 3%. And most of that 3% vacancy is functional obsolescence. What I mean by that is it's a building that's vacant, but the clear height is not high enough for a tenant to come in there and use it, or the power availability isn't there. So it's not that it's vacant because there is lack of demand. It's vacancy because it's unusable for the use case that someone wants to use it for. So we're extremely bullish on industrial. We have an open fund right now, which is our industrial growth fund. We haven't talked a ton about it. We've only released really one email with a webinar and one fireside chat. And that's because we've been so busy behind the scenes working on this HubSpot transition, bringing Mark and Noell onto the team, standing up the next thing I'm going to be talking about, which is senior living deal and oil and gas fund. But the industrial growth fund is just a fantastic opportunity. Highly encourage people to check it out. It will be open through the end of March. As of right now, it is filling up quickly. So we've talked about moving that deadline up a little bit, but in any case, we'll cross that bridge when we get there. The next trend I wanted to talk about, and this is something I'm going to share my screen for, is senior living. And senior living is an asset class that we've been tracking for a long time. And we're pretty glad we didn't get into it when we wanted to back in 2018, 2019, because COVID absolutely killed the asset class. Net operating income collapsed by 60, 70% on some facilities, and it never really rebounded until now. Because of that, because of COVID, new construction has been absolutely comatose over the last 5 years, 6 years. While, let's go over here, the first baby boomers are now starting to turn 80. The population of 80-plus-year-old adults in the United States will grow by 64% from 13 million to almost 22 million over the next 10, a little less than that, if we look at starting in 2026. But you get the picture. We're seeing an over 5% year-over-year population growth in that demographic, whereas the general population growth in the U.S. is more like 1%. I mean, if we're looking at a multifamily market, we see 2 or 3% annual rent growth, we get really excited. And so it is a way outstripping of growth in the senior space. And that trend is going to continue for the next 10 years. You've heard of the silver tsunami. When you look at demographic trends, there's this big bubble of the number of people that are a certain age in the United States. And that number has been slowly marching forward. into this senior space. And a lot of us have aging parents. And the big problem with the current stock of senior living facilities is that they're not somewhere that you or I or anyone else would want to put their parents. They're depressing, they're old, and there has just been no construction of new, dignified, high-end facilities in the last decade. I mean, it has literally been comatose. We see that here, where this is the new supply, newly opened units, and it is at a 15-year low. And that's paired with a demographic that is absolutely exploding. So we are way behind in building senior living facilities. And this is just another chart that shows the radical underbuild of senior living facilities. Now, that's not to say that every elderly person is going to move in to one of these places. We have a Green Street report here that we're going to be sharing with our investors that's 45 pages long that will talk a lot about this. The market penetration is typically between 7 and 9% of, and the other 90% of people are going to get home care. But one of the things that doesn't get talked about a lot is that the largest killer of elderly people is not heart disease, it's not cancer, it's loneliness. And we did a podcast a number of years ago with a gentleman in the Pacific Northwest who owns a large portfolio of facilities. And we talked about that, about how that's a real challenge with elderly adults is loneliness. And so while there is there's been a shift towards home care, that's tough, especially when one spouse dies, the other spouse is remaining, and that's a really lonely existence. And so we're very, very excited about this new deal that we have coming up. And the last thing I want to show here is this is the expected net operating income growth per sector over the next 5 years into 2029. And when I showed this report to our partners who are building this gorgeous facility down in Florida, he goes, "Well, where's senior living here? I can't see it." I go, "It's up here." It's like it's off the charts. And so we're just incredibly excited about this. I'm going to show a teaser photo of what the facility is going to look like, but this is what we're building, and this is what we're really excited about. This is somewhere that I would feel dignified to put my parents if they needed assistance, if they needed memory care. And with baby boomers controlling 51% of all the wealth in the United States, there's money to spend. So lots more information coming on this, but just wanted to kind of tease this out because it's something that we've been working on for the last few months, more than the last few months. We've been working on this since last fall, and just really, really excited to bring this build to market. We were on site in Florida just a couple of weeks ago. Myself, TJ, and John were there walking the site, meeting with the partners for in our final stages of diligence and getting some videos for investors. So with that kind of wraps up the first part of Hangar Talk, which is just me going on a long monologue. So thanks for bearing with me. I'd like to kind of open it up to the first couple of questions for anybody who's brave enough to do it on the recorded line. And then we'll stop the recording in a few minutes here and just go to a completely open forum Q&A. Dave asked, when we were talking about the oil and gas deal, does this make Turbine Capital the sole GP now for the oil and gas going forward? We are the sole GP. So very excited about that. And the reasons for that, Dave, which I think are important to address, are we want control. We want control of what goes into the fund. We want control of the data. We want to be able to deliver the absolute best experience to our investors as possible and keep our investors as informed as possible. We do not want to have someone else be a bottleneck of information. And we just feel that with the growth in our investor base, we have a fiduciary responsibility to be in the captain seat, driving the ship. We also think that we can build a fund that is more investor friendly than some of these other folks. Just saying it. I think that we want to keep fees to a minimum, be as generous to investors as we possibly can, and we just think we can build a really great fund. Mark, you got anything on that?
Nope, agreed. Looking forward to it. And I think it'll be bigger than the one we participated in, hopefully.
Yep, I agree. It's going to be big. Just to tease it out, the name that we've selected is Waypoint. So going forward, it will be the Waypoint Energy Fund, and we'll be rolling that out over the next couple months.